All right. All right. So, what would you like to start with?
Okay, well, I'm just gonna introduce you initially. We're speaking with Anthony Carpenter, who is a licensed insurance agent in Florida. Please correct me if I say anything that's not accurate. Um, and you're able to write health insurance policies in all 50 states. Is that correct?
Yes, our firm works in all 50 states and we contract with over 237 different carriers.
Okay, so you've got kind of a specialized niche business um, where you work with, in this case, we're interviewing you for the purpose of exploring how we could work with people who are trying to switch over to the health sharing, but they may have special circumstances. In one case, they're an individual. When I say individual, I include people with families,
Mhm.
but they may have pre-existing health conditions, which would not be payable by the health sharing. So that's one scenario. Then we'll move to the next scenario, which is companies with group plans with less than 50 employees who are not regulated directly by the Affordable Care Act. And then finally, we'll touch upon the large companies with 50 or more employees who are regulated. And I'm hoping that you'll be able to elucidate the viewers. You did a very good job on the phone the other day with me, but I thought this was so good, I wanted to make a video out of it so that the viewers, including prospective clients, but also some of the other sellers, can become familiar with you and the boutique nature of your firm and your business. So I hand it to you, Anthony.
Well, thank you very much. So, Compass Health is very happy to partner with ACN and work with you guys. I'm also a member of ACN. So, quick introduction on health sharing. Health sharing has actually been around for a very, very long time. It started mainly with your nonprofits and your religious organizations. And for a long time, they were kind of restrictive, that you had to be part of a certain diocese or sect to be, church to be part of them. And they've actually worked quite well for a very, very long time. So they provide some distinct advantages where a lot of insurance companies are for profit. The health sharing is a member shared organization that shares costs between the members. It's voluntary. You're agreeing to everybody pool their assets to share the cost of medical bills. By doing that, they usually have lower overhead. They usually have lower out-of-pocket costs and have the ability to keep premium down because they don't have heavy advertising budgets and heavy sales budgets. A lot of people, when you're introducing them to a health share, get a little confused. They're like, well, this isn't insurance, or what is, why doesn't it say, Blue Cross Blue Shield, or something like that. And those are things you're going to run into a lot. And the first thing, I always tell everyone, you always want to be, completely upfront with them. And here's an easy case for it. I'm in Florida and my card says Florida Blue. Well, Florida Blue isn't Blue Cross Blue Shield. It's a state-run program that's Guidewell. They just use Blue Cross Blue Shield's network. So in regards to health sharing, overcoming that first perception of it's not insurance, it's a health sharing. Well, health sharings are transparent. They allow you to see where the money's going. They report everything going on, and they have a vested interest because most of the people that are working there are also members as well. So, overcoming that as well. Another thing is most large companies are self-insured. They don't use an insurance company. They insure themselves. So, effectively,
and they use the insurance companies as the facilitator to do the collections and distributions, but they're the ones who pay at the end of the period. They pay the liability.
Absolutely. It's actually the insurance carrier is nothing more than what's called a third-party administrator that administrates the plan and allows them to use a network of doctors. So those are some of the usual ones. When I'm talking to a health share somebody, it's A simple conversation. Are you happy with your health insurance? Well, no, my premiums are really, really high. Would you like to see if you qualify to save on insurance? Great. Now, the health share versus an Obamacare plan. Well, Obamacare plans primarily have very restrictive networks. This plan has no network. You have the ability to choose any doctor, and all the doctor has to do is call and verify benefits. So, unlimited access to doctors and hospitals.
Across state lines as well.
Absolutely, nationwide.
Like here in New Jersey, we have a cluster of very good hospitals right across the state line in New York City. But they would technically not qualify under standard health insurance, but under the health sharing, the state lines are just imaginary.
Absolutely. So the state lines, when you're talking PPOs and stuff like that, off what we call the marketplace insurance, you're looking at PPOs, which are usually nationwide networks, or what we call point of service plans, which are non-network plans, which allow you to choose any doctor you want in the country.
Good.
So that's a huge plus right there, because a lot of people, you may live on that North Carolina, South Carolina border, and their doctors across state lines, or Maryland and Virginia. I mean, it happens a lot more than you think nowadays. People are getting testing done and they need to go out of state, and being able to choose that doctor is absolutely, extremely important to them.
And it's not just a state line issue. It may be that a particular hospital specializes in a cutting edge therapy,
Absolutely.
which is outside the network, or it could be outside the state, whatever. People with the health sharing can travel, for example, to New York from Alaska.
Absolutely.
And it's not going to change the,
Or they can go to a good state for medicine, like Florida.
Yeah, there you go.
But and if they ask, how does it work? And it works just like any other insurance policy. You pay your premium. You have what we call your individual, I call it individual responsibility amount instead of deductible, because I think individual responsibility is just a little easier for people to understand. And you have that for your family. And then after you hit your max, you're covered at 100%. Now,
isn't there a 10% copay still?
There could be. I'm just being general. I wasn't being as specific on it.
Okay. Yeah, I think with the plans we're using, we're selling, there's a 10% copay that continues.
Yep. And once you hit that, and that'd be a 90-10 plan, which is still, once again, completely, cheaper, because most plans, after you hit your deductible, you hit your co-insurance to hit your family max out of pocket. After you hit your family max, then you're covered until you hit your year end or the max out of pocket. Leads into another good question. Well, I see plans that have anywhere from $250,000 limits to $500,000 to $1 million, and I can tell you, you could have cancer and be treated with chemotherapy. You are not going to spend $1 million in a calendar year. It's not going to happen. I've seen people, and hundreds of people, in all kinds of cancer treatments, radiation treatments, IVFs, you name it. It's not going to, and here's why. The insurance company and also the health sharing companies are going to reprice it. So that $100,000 bill is going to get repriced down to $30,000 once they start negotiating it down. So a great example is I had a customer the other day who had a hip replacement. Right here, Tampa General, one of the top hospitals in the country, $197,000. Before anyone paid a dime, it was repriced. It's repriced for the one part down to 60. Then they break it up into little bills. They break it up into the surgeon bill, anesthesiology bill, all that. After they broke that whole bill down and he paid his individual amount, the insurance carrier paid around $17,000. That was it for a total hip replacement, 4 days in the hospital. So those are some of the things you're going to run into. Also, the ability to pay. Well, that's public record. And if, let's be honest, 90% of the insurance companies make money off of not paying claims. Here, you're with a health sharing organization that prides themselves in sharing claims and rejoicing in being able to help people out, because that's what helps them and helps them grow. Where Other carriers, which you see them on the news all the time, they're about the shareholder and they're about the bottom line. So they're going to try to deny first.
Oh yeah, they're going to play every game in the book and then make up new games every week or two.
Absolutely. And listen, I'm not knocking any of them. I work with them. I sell them all. There isn't a plan out there. But these are some of the things, that are out there. For a family, where, I see families paying $1,800, $2,500, $3,000, dollars a month for healthcare, when you can save them, seven, eight, $9,000 a year. It's absolutely amazing. It really is the financial savings there and the ability to access care at an affordable rate.
Yeah, the health sharing is considerably cheaper for comparable value, comparable effective value. It's much cheaper. Correct me if I'm wrong, Anthony. It's never going to be a Rolls Royce. It's never going to be equivalent to a Rolls Royce health insurance policy. But you're not paying Rolls Royce. You're not even paying Chevrolet. You're paying Chevrolet minus 50% or 60%. Does that sound accurate to you?
And that's accurate, because here's the thing. I don't care what plan you have. There's no such thing as the perfect health insurance plan. There's costs. And if you go in the marketplace, the plans are all built the same. They're all built on tiers: bronze, silver, gold, platinum. So every insurance carrier obviously has built in for you to have, out-of-pocket cost. And I would rather save in premium. If I save $7,000, $8,000, if I have to pay $125 because I saw a specialist or I had a test after it's discounted and repriced, well, that's way better than me paying $7,000 more in an annual premium. A big problem that most people don't understand is all medical insurance has what we call a base price. And as soon as you start adding copays and all those things, the price goes up and up and up. So they've already priced in testing, blood work, all those things. Why do I want to give it to the insurance company if I'm not going to use it several times a year? If I'm not going to get $6,000 worth of blood work, why do you want to pay for it? And that's a big thing to people. If I'm a healthy person, if I'm a family of four, we're not having any more kids, we go to the doctor once or twice a year, and we know we have great coverage if something happens. Well, I'm going to save the $7,000, and if I have to pay $100 here for an allergy test or an extra test just in case, well, I saved myself $7,000. So when people might say, "Well, is it covered?" And covered means, by definition, an insurance company will pay after all co-pays, deductibles, and co-insurances are met. Then the insurance is responsible for it unless it's otherwise specified. So if you think that you're getting a copay, it's factored in the price. Someone's paying it, whether the government's paying it or you're paying it. It's in there. Your blood work, all those things, they're in there. So health shares allow you to take control of your medical costs. You're the one that controls it there. You can go, well, instead of going to the hospital, I'm going to go to Quest Diagnostic over here and only pay $75 and save myself, and I'm still $6,800 and thing. It gives you a lot more flexibility. You don't have the networks. You don't have the same rigors that goes in there. So when you're talking to people, it's a way for you to pick and a la carte your own health insurance experience for your family.
Right. So that was really good, Anthony. So moving on, to the first scenario, which is you have an individual, which could mean a family, where one or two of the family members have, let's say, diabetes.
Okay.
And they can save some money by moving most of their coverage, to call it something, to the health share. But then they don't want to be exposed on their pre-existing condition. So your firm has certain hybrid techniques. You specialize in patching together a hybrid combination where they might buy a policy from you on the regular market and also use the health share, but I want to make sure that everyone understands. You can't use both plans on the same claim. It just
No,
gives you the flexibility.
no, you can't
Right,
use both plans. You pay both plans in the same plan because it's called coordination of benefits. Coordination of
right,
benefits will not allow it. But a good example is, let's say you have we're going to use a child, a type 1 diabetic, a little more extreme than,
right,
type 2 diabetes. That person, that's going to require a little, heavier care and things like that. Well, you would use them, let's just example, a marketplace plan or a plan that would cover that. And we would coordinate that to be able to, fit, with them. So instead of the whole family having to be on that marketplace plan and spend, I'm just using marketplace as an example. Please, I'm not knocking it, but on that plan and pay that large amount and have that a really, really large family deductible, we would have one person on that plan while the rest of everybody else who's extremely healthy can participate in that health sharing. And you're going to save that family thousands of dollars. With the child, here's the thing. Here's the best part. He only has his deductible to worry about, not a family deductible here. So you took undue risk away from the family by splitting them up. If something happens to him, it's only one deductible, one max out of pocket.
right,
He's covered at 100%.
right,
Instead of having to worry about a family max or anything else, you're all giving that advantage to him to get the care that he needs while saving the
right.
family. Now, nothing's ever perfect, but yes, that's what we look to do, whether it's a marketplace plan or private. We do have private full major medicals that cover all pre-existing conditions in all 50 states. But those are the types of plans we partner up with you guys, for.
Okay, good. And you're specialized in this, and you sound like the professor of this channel, this category of insurance business. So I'm glad to have you advising everyone. So
Well,
okay, so that's one scenario.
Mhm.
Yeah,
So what makes us different? And it's our firm process. I'm not the guy that's going to go spend a bunch of money on advertising. I partner with people like ACN, other agencies out there, because we write all the plans that other people can't write, and that's what we specialize
right. And so good. So then moving on to the next
in. Perfect.
scenario, which is we have a company with 40 employees. They're not mandated to offer health insurance of any type, but either they want to because they want to attract better employees, or
Absolutely.
they may already have a plan in place, and they can't just remove it, even though they're allowed to remove it, but they want to save some money. So either of those two contingencies, again, we bring you into the picture, and
So
you
they have three
handle
options
it.
there.
Yeah, right,
So they have three options. So since they're under 50 employees, it's basically they're giving it as a voluntary basis. They're not locked into any contract at that time. So
right,
they can make a change. So they can go in and say, okay, we want to, they can just, honestly, you can just skip me at that point and add it as a carve out, or you could combine it all together with what we call a standard plan and a plan, like ACN, or they could just do away with that plan, offer ACN and, what we call, voluntary benefits like dental, vision, accident coverage, things like that. So under 50 employees, it's completely flexible to them. The law states, okay, that technically, you can write a group plan with two people as long as they're not married. So it's very flexible, because you have some companies. We'll use a good example is, take a like electrical company. They got 40 people. Most of their managers are sick. Let's say older, 55. They have 4 or 5 good ones they want to keep, but they got 18 to 20-year-olds, 25-year-olds that don't have $400 or $500 a month. That's where a health share would be a golden opportunity for them and their families. You got those guys making $15, $18 an hour. You have that as an offering for them. Your participation would be amazing. And then the old guys, and statistically, we write a lot of group business. I don't care what anybody says. If I got 40 people, you're going to get 15 that are unhealthy, period. And you can have that, and you're going to get the majority of the members. If you look at your trades, you look at you look at plumbers, electricians, you look at metals. I mean, they hire a lot of young people that don't have the finances to spend $1,200-$1,500 a month for a family. So you offer that one high-end deductible plan for the upper people that are sick, and then you offer a plan that's going to be 40-50% cheaper for them, and it allows them to have the best of both worlds without incurring any other administration costs.
Right. Okay, that was also said very well, thank you. So let's, I guess, move on to the third category, which is the ACA mandated or regulated companies with 50 or more employees, and how
Yes.
that would work. Yeah.
So if you have over 50, what we call full-time employees, you have to offer what we call ACA compliant coverage, or you have to meet the minimum essential coverage standards afforded by the Affordable Care Act. It is a $1,600 and something fine per employee. We talked about it the other day. I have to remind myself of it. Companies don't want to pay that. They also can get complaints from OSHA and other things. So when you're dealing with 100 and something people, you want to make sure you have that. So companies do offer health shares. I have a very big church in Georgia that does a health share, and they have 500 people on it. So you have to have something attached to it that meets that coverage. So you have to have what we call a MEC, a hybrid attachment to that. They're very inexpensive. They're very cheap, but it meets the standard for the ACA coverage, and it also meets the reporting standard for the required minimum coverage for the Affordable Care Act. Now, the company can choose to pay the fine. I don't know any company that would want to, regardless of what they're saving on insurance. Also, when you're dealing with 100 and more employees, you're dealing with something very, very prominent in the United States. Over 88% of all businesses with over 100 employees go through a PEO. So PEOs package it all together. They're going to do the workman's comp. They're going to offer the health insurance, and they're going to offer the dental, the vision. They're going to piece it all together, and they're going to tell you that if we package it all together, you're going to get a discount on this, 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 and this. They're lying, and that's when you absolutely need a firm like us. There's very few firms.
Okay, so wait a minute. So you said 80% of all the firms with more than 100 employees are contracted with these
PEOs?
what you call PEOs? Yeah.
Uh-huh.
And they're all getting song and dance, is what you're saying.
Not all the time. Some companies have to use them, like certain building companies, depending on how many people they sub out, depending on subcontractors or other rules. That's really complicated, stuff. But in general, a PEO is a professional employer organization. They're massive. I mean, Paychex, ADP, Sunity, they're very, very big companies. And what they do is they give you what's called cookie cutter benefits. So, they're going to do, health insurance, dental, vision, short-term, long-term disability, and they have it usually in a contract. So if you're going to do a carve out, 90% of the time for reporting, they're going to want to work with easily someone like us, because just for platform convenience alone, there's 6 or 7 major platforms nationwide for reporting on it. Also, what do they want to peel away? What's the penalty charge? Do they just have it? So those are a little more complicated. That's absolutely when you need a relationship with a company. So one of our specialties is PEOs come to us for what we call carve outs. So it's where the business goes. We're just going to use Oasis as an example. And once again, we work with them. They go, our health cost is too expensive. We need other options. And they will come to us, and we'll carve out their health insurance separate from the PEO while everything else stays with the PEO. And as long as they meet the ACA compliance, they're fine with it. And we work well together, and we shake hands, and everybody's happy. So when you're dealing with companies like that, you have to deal with the PEO. and they're the big one because they're doing the workers' comp, which is a huge portion, of their insurance and their bills on a, monthly basis. So we
Right.
specialize in PEO contracts, how to, work around the contracts, how to work with them. We work on every platform available. So to partner, with, adding that as an option, or doing that with over 100 people, it's a little longer process because it takes a little time because you have to get a bunch of information. But absolutely, when you're dealing with that, you have to have an attachment to make it ACA compliant.
Okay. And those, you can put together those hybrids relatively affordably.
They're they're extremely, so if you have 100, let's say 100 employees, and let's say you have a family of four, I've seen you can make them as cheap as $20 per member, 20, on up. You can build them very, very rich. They're very customizable, across the board. Some people are going to understand that, you know, once again, not understanding that, the PEO says, well, you have to have above 50% participation. No, it's just that PEO's contract with the carrier requires them to have that participation. They won't have to lose that carrier. So if they wanted to keep, let's say, United Healthcare, but the PEO says if they lose less than 50% participation, they can't have that plan. Absolutely, they can have that plan. We would just come in and be the administrator of that plan, and they can keep it and add the same plan.
Okay, real good, Anthony. Well, that was incredibly helpful and enlightening. What else do you have that you feel should be mentioned? Because I've gone through my list of questions.
So a couple things and I think whether I'm talking to a new agent or a person in general, when you're talking about a health share, the confidence of learning what it really is. It's a health sharing organization that's there to share expenses with its members. And one of the biggest bright points is you are now having control over it. Instead of you having to pay thousands and thousands of dollars, it's in your pocket. And you're only paying for really what you're using there, instead of the insurance company keeping it to just in case you need something. They have outstanding repricing, which averages, let's just say nationwide average about 63%. Sometimes higher, sometimes lower, depending on the services. So with the network repricing, the wholesale prescription drugs, about 80% of drugs out there are cheaper on discount programs through the average copay, with your standard prescription drugs out there. I mean, most people on high blood pressure medicine, it's cheaper for them to go to Piggly Wiggly, Publix, and get it for $6, where they have a standard copay with their current employer at $10 or $20. I don't know about you.
Okay, so
Hmm?
I'm sorry to interrupt, but I think that's very good you brought this up because I would have overlooked it. Uh, Discussing the dynamics of the prescription deep discount program that comes with the health share versus the standard prescription coverage that supposedly comes with the various major medical policies. What you're saying is if a person's a little bit astute and they use the tools, like, for example, Impact Health Share has an online tool
Yep.
where it prices out the prescription in your general vicinity within whatever 10
Yep.
miles of your house, and it'll show you where the cheapest price is. So if you're willing to drive 5 miles, you can maybe save whatever $50 on a prescription. And what you're saying is that in many cases, or maybe you even said most cases,
In a lot of
using
cases.
using the prescription deep discount program winds up with net costs below what the copay is when you're just using the standard major medical prescription coverage plan. Is that more or less what
Absolutely.
you said?
Because
Yeah.
your standard preventative drugs, okay, there's $0 or $3, which that list is very, very small. And that's just your standard, cookie cutter program. Now, Lisinopril is not considered preventative; it's considered maintenance. So you're looking, right there. And I'm just using that because that's a really, really cheap drug. I mean, if you go through it and you go to their, cost analyzer, you go, well, wait a minute, you're paying this over here because Cigna's not, it's not in their formulary, so you're paying $600, but based on this deep discount, you're paying $100. I mean, once again, that's you being in control of your own health costs.
So in other words, if I understood what you just said, is you may get prescribed a drug that's not even permitted, or it's not covered by your major medical at all.
Depending on the formulary. I've seen some good ones and some really bad ones.
But generally speaking, you get some relief, and it could be a lot of relief off the rack rates, the retail prices, by using the discount program.
Yeah, and another thing a lot of agents don't tell customers, and we're gonna use the ACA market, Obamacare, where for easier for people to understand. And it doesn't matter what state. I write in New York, I write in Maryland, I write in New Jersey, California, Colorado. A lot of those plans have what we call is prescription deductibles on top of the regular deductibles on the plan. So bringing those aware to people and helping them go, hey, listen, great, you got this coverage over here, but you got an extra $2,000 prescription deductible. Over here, this is your total cost. And taking that time with your client to really let them play with that prescription tool is going to be great for you. It's a great weapon. It's a good tool to see people that, because I know plenty of people out there that will go, well, wait a minute, I didn't even know. I was like, shoot, that's not a prescription. That we work with about 100 different discount programs out there that all link them together. And 8 out of 10 times I can find a discount card that's cheaper than most of the prescription covers on, group plans. So it's a great tool. Use it all the time.
That's what everyone says. I've not used it yet. So I'm, relying on what I'm being told, but I hear this so often with such enthusiasm that I'm, feeling like there's got to be, it's got to be real. Even though it sounds a little too good to be true, I'm figuring out, no, it's true.
It is, and it really is out there. I can tell you, so I can write a custom plan with basically a la carte that can cover anything and nothing. And if you take out, someone tells me, they take an allergy medicine, and I take out your standard, compliant prescription drug coverage and just use discount programs, you're going to save them $1,200 a year in average. That's just an average, obviously, but it's a great tool to have. So having that confidence, with them, getting their information, passing them on to, what they need. A lot of people, you're going to run into people that get things in their head because they're so used to, hearing, things and, seeing things. Well, and I've run into it all the time. And, especially, here's a great one. Well, I Blue Cross Blue Shield. Does your car say Anthem on it? Well, no, then it's not Blue Cross Blue Shield. It's whatever state run plan you have. So, it's really educating them, really taking them the time. And once we peel that layer back and really educate people on what's out there, because at the end of the day, if you're healthy and you're on the exchange and you're not getting a huge tax credit, you're wasting money all day, 100% of the time. You're just absolutely wasting money. There's no reason for it.
Right. There's so much money in the whole system that's being wasted. It's being poorly utilized, inefficiently used. A lot of it's winding up, in corporate profits and so forth. And people have coverage that really is not ideal to them and their family and their circumstances. So, again, as I'm hearing you say, your firm specializes in creating these a la carte, hybrid programs. And you also can save big companies. Let's say the big company looks at the health share and says, you know what, we're not ready for this. But if you think you can save us some money on our group plan, go ahead and bid on it. So in that case, Anthony, you would take a crack at trying to save the company some money on equivalent coverage. Is that correct?
So on a large company, it's very factual. And on a large company, there's about 5 major players and about 20 what we call third-party administrators, and they all are bidding back and forth, but for the same piece of pie nationwide. There,
Right.
that's but what we save them is 9 times out of 10, it's the administrative costs which allows the price to go down because it's not the PEO, we're not jacking up the fees. They don't have administration fees because we'll go direct to the carrier or direct to the TPA and let them use it on their platform with their PEO and do it that way. That's how big groups get bidded, and they go through a cycle. Like right now, I can tell you, United Healthcare is in Texas is bidding on everything, then get the little pause on. And it
Right.
changes a lot. But in the big group market, a lot of them are just grouped into cookie cutter PEO plans. Sometimes, hey, listen, if it's a great plan, I'm going to tell you it's an absolute fantastic plan. Stay where you're at. If it's not, if you've been with the same carrier for, let's say, 5 or 6 years, 9 times out of 10, another carrier is going to beat their price because they already know and they want the business.
Going back to the years of when Bill Clinton was first elected, and he put together this team, including Hillary, who was supposed to develop health insurance like government-run programs. Everyone gets insured. I remember I was on a flight. I don't remember where I was going, but there was a convention of doctors. I think they were surgeons, and they were all flying, maybe to Las Vegas. And I overheard the conversation. And one of them said, because they were talking about these plans that the government was trying to implement. And I remember hearing one of them say, if they think I'm going to get up in the middle of the night for less than $300,000 a year, they're crazy. And this was
And
back in like 19, this is like back in 1993 or so.
And fortunately,
And
a big point, to piggyback off, what you're saying is, I can tell you for certain that there are, and I'm in Florida. It's a great state. I can tell you right now, our number one orthopedic, we have one of the top orthopedic institutes in the entire country. They do not take any Obamacare unless you have private insurance. They don't take. It's cash only. So
right, but the point, and there are some boutique doctors I've been to them. They're like that. They don't need it, take insurance. They don't take insurance. But the point I was going to make is, back in that era, 1993, they were complaining because they may get a pay cut down to 300,000,
yeah,
and but yet they're not making 300,000 today after inflation for all these years. These same specialists,
hmm
and in the meantime, the price of healthcare per person, per citizen, has, what is it, quadrupled, quintupled, something like that?
yep.
So something's wrong there. There's something wrong with that picture. The doctors have been cropped back to maybe 50% of what they were complaining about 30 years ago, and the price for everybody is quintupled.
Oh, absolutely.
So this is what we're dealing with. There's a lot of waste, fraud, and abuse in this system, and we're trying to make the best of it. And you're the professor of this category of commercial health insurance. So
And a cool add-on, so a big thing is like dental vision, your supplemental things. There's not one carrier that we don't work with, out there. So I only sell dental policies with like no waiting periods and things like that, but we work with all of them nationwide. So there's an estate or a plan out there. I can in confidence tell you there's not a dental vision supplemental plan that anyone sells that I don't sell. Period.
so yeah, so I'm so glad and grateful to have been introduced to you, Anthony.
I
And
appreciate it.
as I said, I'm going to circulate. I'm going to do a little chopping of this video because it's too long for everybody.
Yep.
So I'm going to cut it into segments. But
Okay.
I'm going to distribute it out, and I guess that's it from my side. Do you have anything else, or does that conclude it?
No, that's really it. If anyone any questions, I'm here as a supplement. I don't want one member taken away that should be on that health share. I want to help you sign up 5,000 because
So yeah, so I'm gonna wind up hanging your contact info and your phone number. With your permission, I'm gonna post a banner right on the video
please do.
so people can get in touch with you. And once again, thanks so much. It's been incredibly helpful.
Thank you. You have a wonderful night, and I'll have Corey show me how to fix the recording.
Real good. Okay, so we'll speak soon.
Thanks. Have a good one.
You have a good one. All right, bye.